before you deploy your funds or resources, or before you make the decision to buy any stock in the stock market, you must do a thorough research and analysis. Now, that is what we advocate on Clockwise. This is why every time we sit here, we tell you the stocks we are investing in, and we don't just name these names, but we tell you why. Welcome to Clockwise. My name is Providence. Today we'll be talking about 6 cheap stocks we are investing in today, and we'll give you the reasons why we are investing in them. I don't do it alone. My guest is here, the one that sleeps on the charts and also sleeps on the fundamentals of these businesses. With a resounding virtual round of applause, welcome, Mr. Kane. Welcome to Clockwise.
Thank you very much for having me.
Before we proceed to what we're actually discussing today, which would be 6 cheap stocks we actually invest in, we're investing from this point, let's look at what is going on in the markets. Now, we are seeing more red candles in the markets. What is actually going on? Are we moving towards a recession?
No, we are not moving towards a recession. So what we are having, there are 3 things that are causing the strain, very serious strain on the equities market. Number 1, you've seen that the government, the debt management office has been very, very bullish on fixed income.
Okay.
Look at the OMO that we just got. Just for context, last week alone, on Thursday, 13th of August, the debt management offer of the CBN actually offered 600 billion. But guess what? Over 4.93 trillion actually came after that. Bids came after that OMO auction. The OMO auction was just 600 billion, but you had subscription of over 4.93. Now the CBN went on to give 2.6 trillion. What does that tell you? It tells you of, for starters, this is offered at a stop rate of 2.3. I think, a stop rate of 2.39. That is very attractive if you ask me. Look at the NTB, the 364 was coming at 17.59. And then you have this one coming at 20.3, which means it gives such a huge opportunity. And by the way, it's been decentralized now. You can literally buy through your deposit money bank. So that all of this are literally sucking away from the liquidity that would be available for the equity markets. That's so that huge emphasis on the debt market, on the fixed income market, is because when we look at it, the equity market is part of the investment vehicles that people have. And so when one market becomes very attractive, remember this is a very attractive market, and most especially with what happened to Geregu, a lot of people are now moving so much into government instruments now. So that's why you see almost all the fixed income, government security, fixed income security is now oversubscribed.
This is the first time we are seeing the government so interested in the
No.
in the equity market.
In equity, did you say equity or debt market?
Debt market, right?
No, I mean, so the way it works is this. The government uses OMO, open market operations, to mop up excess liquidity, and this is the liquidity. Unlike treasury bills are used to fund project, fund deficit, but OMO is specific. Is used to manage liquidity, and the CBN is very bullish on that matter now. But my point is, this liquidity would have found its way somehow into the equity market. So when you have if you have an instrument that is paying as much as 20%, that to me is would bring such a strain onto the equity market. And that is why even the names that we are going to mention, you see, are names that are prone to benefit in this high interest environment. That's number 1. Number 2, whether you like it or not, people are taking profits. And one of the biggest profit drivers is that, Dangote listing is coming in. And we are looking at September or early October, for the Dangote listing. But whatever is the case, people are already reallocating, they are already rotating out of some. So I know of somebody, a client actually, that has rotated out of equities, is putting it into fixed income with the hope of eventually pushing it into Dangote refinery. So that is another strain on its own on the equity market.
All these are affecting.
All these are affecting the equity market. By next month, schools will resume. A lot of parents have liquidity requirements, liquidity needs. So that is also going to, people offload their positions to be able to meet up with some of those liquidity needs. So all of these things, and by the way, this is not something that we had actually said it, if you observe, back in the month of July when the equity markets picked up, we had already said that we expect all of this slowdown, dislocations would happen. But for me, it's an opportunity for people, discerning investors, to take advantage of this opportunity and allocate into position. We've seen a couple of companies that are doing right issues. I mean, you see Dangote Sugar. Dangote Sugar did the right issue, and of course, it was offered at 16 naira. So that's why you saw the market go down as far as 64 naira, because some of the people that receive those new shares offloaded themselves, the investors. So there are a lot of that. You are going to see a lot of dislocations around this period. So for me, you look at the quality names that have strong earnings power, names that can afford to thrive in a high interest rate environment, names that have very good earnings growth profile, names that are able to with strong return on equity. Those are the names that you should be looking at investing. And I think that's a lesson for us.
All right. Now, when we talk about cheap stocks, what do we actually mean? Are we calling them cheap because of their price? What do you mean by cheap stocks?
Okay, so cheap for me is, another word I could use is undervalued.
Yeah.
Cheap stock is not because that stock is selling for 1 naira. But cheap stock is a stock that when you compare that stock with its contemporaries within the industry, a stock with strong fundamentals, but is selling at such a discount, a discounted valuation. That for me is a cheap stock, because I know that when the market re-rates, then you see those stocks coming up very powerfully. I mean, we've seen examples. Look at what happened for Nigerian banks a couple of years ago. What you had was, is it that the fundamentals those banks were not strong? No, but because of the macro environment. The macro environment, were quite hostile. Not just banks. Look at the industrials. Look at the consumables. Look at the telecoms, most especially telecoms. You saw they were seriously beaten down, not because the intrinsic value of those companies had gone down, but because the macro environment was hostile to this name. So for me, if you look at that, you realize that is when those companies were undervalued. But when those headwinds cleared, guess what? The markets re-rated those names very quickly. Okay. So for me, I would always say I'm a value investor. So I would always look out for names, strong names that are, take an example of Warren Buffett. In 2008, 2007, Warren Buffett started offloading a lot of the equity holdings he had. Offloading. People were like, this guy has lost his investment streak. But that's not what he was doing. He was actually offloading because for him, he thought asset prices had been overpriced. And by the way, that was that was true really, because at that point, people were very reckless about investment products. You have a bunch of terrible, non-performing MBS, that's mortgage-backed securities, packed together by investment banks and sold to just about anybody. So people like, Warren Buffett was doing that. People like Michael Burry bought, credit default swaps. I'm not going to discuss that, but that credit default swaps is, when you are betting that a particular price would fall. When you bet that this thing is is of terrible value, and then when the market actually realizes it will fall. So I mean, those guys made a ton of money. So for me, when you see those things happen, those actually show the true nature, the true definition of some of these names. Market re-rates, and then you have a very serious. You see the those names that were beaten down come back up very powerful. So cheap stocks are stocks with strong fundamentals, but selling at highly discounted valuations.
Okay, now, is it just about the price? Are there possibility that a cheap stock can remain cheap for a very long time?
Yes, if that cheap, that's why I talked about the valuation actually.
Okay.
If that cheap is because of deteriorating earnings, before I actually invest in a company, the first thing I do is fundamental analysis. I pick the company's earnings financial report for at least 7 quarters. Yes, 7 quarters, and then I look at this quarter, look at this quarter, look at this quarter. What am I trying to say? I want to see the earnings growth. I want to see the return on equity. I want to see the bottom line. I want to see the revenue, the top line. I want to see the equity. How has the equity position, that is what we call the shareholder value, how has it moved? Now, if you see a company whose earnings, whose revenue is dwindling, even if, and is dwindling consistently, even if that company's share price, in fact, that is the last thing I look at, the share price, because it is possible for a company's earnings to dwindle consistently, and then that company will still be, because that is hype, and hype can last for so long.
Yeah.
You see a company, I'm not going to mention names for this particular one, but a company is performing very poorly in terms of its core business, and then maybe it's making money from investment income. A company that's supposed to be, for example, let me even use a space, insurance space. Insurance, you are supposed to make most of your money from what? From underwriting risk.
Yeah.
But you see a company, in terms of underwriting risk, the income it's making from there, is revenue from there is nearly zero, flat. And then, but he's making so much money from investing in fixed income and getting money. That is a risk for me, because
They're not making money from business.
No, beyond that, that environment might not last for so long. What if the CBN decide to reverse course and begin to lower interest rate? Look at inflation. Inflation has come down from 15.91 to 15.43. So what if the CBN reverse course? Remember, even this thing we are talking about, OMO is not something that it's used to moderate liquidity. It's used to
It's very sustainable.
It's not sustainable. It's a kind of an emergency tool from the CBN to control liquidity. So once liquidity is tamed, you might not have this excellent rates anymore. So if that happens, that means that insurance company that was reliant so much on interest income would see its revenue drop scandalously. So that's why, for me, I look at the fundamental, I look at those things, and then if the fundamentals are growing, the earnings growing, the return on equity growing, and then the stock price seems stuck, that is a dislocation for me. Yep. So I'm most likely going to buy that name, knowing that by the time the market re-rates, by the time the market wakes up to the core fundamentals of this name, then I'm going to be having a very good upside.
Now, let's look at those cheap stocks. What you feel that, based on the current situation going on in the markets, what are those cheap stocks you can actually invest in, like 6 of them, and why?
Okay, so let me tell you, I have decided to start from an industry that I scarcely mentioned on this show. And I have my reasons for starting. That industry just went through you know what the Bible says, it talks about passing gold through the fire to refine it. So that industry just came out from there. But I know yeah, people would say that industry is down 5% year to date. But I mean, like they say, you invest when there's blood in the street, including your own blood, knowing that by the time things will wake up, then you'll be in a good shape. Yeah. You can guess that industry, insurance. Yeah. Insurance space, I mean, they just finished the recapitalization. So I believe that now that the recapitalization is over, investors will begin to reprice most of the insurance companies in the country. I'm not saying this because the environment that we're currently in really favors them. Because, I mean, it favors them because only interest income is enough momentum for them. Yeah. Apart from underwriting risk, I mean, the premiums that they collect, they can actually pack them in the fixed income market and make some 20%, from OMO, and of course some 18% on other instruments. Now, but I'm looking at two names in the insurance space, and there is a reason why I'm looking at this, because I believe that it might be down. The insurance index might be down 5% year to date, but I believe that there's some sleeping giants in that industry. One of those giants for me is custodian investment. Custodian investment, because number one, within the insurance space, it is very diversified. Yeah. So that concentration risk does not exist. They do a lot of underwriting, and then they actually also are diversified enough to ensure that they have different revenue streams coming. I mean, it's a company that's sitting on is valued at over nearly 400 billion naira. So it's strong, very decent cash flow. If you look at its compound annual growth rate, over 40%. Yeah. So for me, custodian investment is a name that you should be looking at, and I think it has retraced down to a good position. I'm not going to be like doing a very. I'm not going to give specifics, but custodian investment is at this very decent positioning. I still expect some downward momentum though, but I think that even if you start allocating at this point, it is still a good, a decent position for me. 71.85. That's where it's currently trading at. It's still a very good, because if you look at it, it's coming down from all the way from 90 naira per. So that is a very serious discount for me. I still expect it to come all the way down based on technical part of this price action. It's been all the way to maybe 66, at least 66 naira per share. But even if you start allocating at this point, I think it's still a decent entry for me. Okay. So that is for custodian. The next one is name. Okay. Name. It's an insurance company. Name is still an insurance. NEM is still an insurance company. Name is one of the behemoths in the space. I'm particularly interested in people that have what we call underwriting discipline. For an insurance company, there are some make or breaks. In underwriting discipline, it means that you take risks that are properly that are calculated, so that you don't have to spend so much of the insurance premium in indemnifying your clients, your policyholders. So, and then that may also allows you to have so much to also invest in the other income sources, like even the fixed income as we speak of. And I think name is one of those names. No pun intended, actually. But name is actually one of those names that you would look at in that space. It is well structured. Let me look at the price action. I think it could be, and it has had some good run up as of late. But let me look at it very quickly. It is still trading at a premium. It's still trading at a premium, but I mean, it could be something you can put on your radar. And then because of that, I would pop in another name. Name is a strong play. So the only challenge is that if you look at it on the weekly, it is still at a premium valuation. But the point is, I mean, now that recapitalization has happened, you can see some of these names will actually re-rate very quickly. So for that reason, maybe this might not be an immediate buy, but you can start. When I say accumulate on this show, I mean you can start allocating. You might not want to go all in at this time because it is still trading at a premium. So because of that, I would pop in another name, and that would be ICO Insurance.
The insurance companies
Insurance companies, because of the way we are in a high interest rate environment, so insurance companies stand to benefit because they have idle cash sitting. ICO is still on a weekly, still on a premium, though. ICO Insurance, that is speaking technically, still on a premium. But these are very strong names. If you want to look at, if you are looking weekly, where you will be looking at allocating, where a good price to buy ICO will be 2 naira 48 kobo.
Okay, if you're looking at it weekly.
If you are looking at it on the weekly time frame, a good place to buy would be 2 naira and it's currently trading at 3 naira 94 kobo. So is there a chance for it to get to that? It could, because there is a very clear fair value gap between where it is now and the price point I just mentioned. So if it attempts to fill that fair value gap, then you could be looking at 2 naira 48 kobo. So those are the for the insurance stuff. And for me, at this point, insurance names will be. Is it possible for it to move up from here? It is possible. But as a value investor, I would rather want to at least see it for this ICO insurance, at least see it come down to about 3 naira 20 kobo. You know, that is where I would believe it's a good place to start moving in aggressively. But if it comes all the way down to 2 naira 40, 2 naira at least 2 naira 50 kobo, then I would be very aggressive, because that would have taken it down to a very, very prominent. And of course, ultimately, at 1 naira 60 kobo would be that would be the last leg in terms of the demand zones that cause this price momentum. Okay, so that's for the insurance names. I think these are some of the winners at this time. The other winners I would look at would be purely based on valuation. When you talk about cheap, I told you valuation. I would look at a name like Access Bank.
Okay.
I know that Access Bank has always been, this channel could even be named Access Bank channel.
You can be so surprised if you don't name Access Bank.
But I'm naming Access Bank because among the forecast, it is the cheapest. Access Bank is the cheapest. Access Bank is trading at 1.6 times earnings.
Okay.
At least that's based off of the Q1 earnings. Of course, Q2 is not out yet. Half year is not out yet. But based off of the Q1 earnings, Access Bank is trading at 1.6 times earnings. That is, for a tier 1 bank, that is screaming cheap. It's screaming cheap. What are the things? Credit quality. What are the other things? In payment charges. But these things could re-rate very, very quickly. Access Bank for me is a continental play. You are at this point, I've always said it, you want to get into a name that allows you to diversify away from a geographical risk. Access Bank is that name. So what are the other things that in an high interest environment, a bank that is sitting on 52 trillion in assets can afford to deploy that assets and to make some decent return. So that for me is why I still believe Access Bank is is it a good, for me, Access Bank has been in this particular consolidation on a weekly time frame since September of 2025. Think about that for a second. So it's been in this broad consolidation phase. Currently it is trading at the upper end of that consolidation. So maybe if it comes down to maybe somewhere around 20, at least from 22 down, could be a discounted, within that consolidation, could be a discounted point for you to gain into access. But Access Bank for me is a good name. The next one, still in the banking space, that I will talk about is maybe not so much in valuation, but in terms of, partly valuation, but also partly because in as much as you're looking at something that is cheap, you are looking at something that allows you to gain broader exposure. When I say something is cheap, I mean that for what it offers, the price it is selling at is still very low. UBA. UBA is priced more than it's selling. Is in terms of valuation, it's more than Access. Yeah. But UBA is present in over 20 countries. Yeah. So that means access FX. That means access to a diversified pool of income. Gosh, yeah. Something happens in Nigeria. There's a policy change in Nigeria does not translate into a panic for UBA because of its spread. UBA is a name, and currently it is trading because both UBA and Access Bank suffer from the same challenge.
Investors really punished them,
and investors have really punished them. So I think
it's time for them to get up.
It's time for them to get like you say, it's time for them to get up. Within the broader range, it is now at 50% of that range. Okay. So for me, if a name is at 50%, it's eligible for you to start accumulating. Do I believe that it will come down? Yes, because for the candle of Monday, 13th of July, there is an imbalance between that candle and between the way it is trading at this point. That candle was formed started at 41.15, 41 naira 15 kobo. But at 45 naira, it's still I think you can begin to accumulate. So UBA is another name.
Number 5.
Now,
the last one.
Then the last one would be, I know it's going to suffer a dislocation, but it is in the telecom space. That name is MTN. Okay. I can't talk about it now. We are talking about cheap. You talk about
MTN is cheaper.
MTN is cheap.
Yeah.
If you observe what I did, I went from the insurance to the banking to the telecom. Why am I saying telecom? Because MTN is sitting on such a cash pile. Yeah. If you look at their last report, you see that they are sitting on their cash balance is good. Now, what does that mean? It means that MTN can even benefit from this high interest rate environment. By the way, remember that inflation is coming down, but we are having this, so they can benefit. That's number one. Number two, they are still cheap. MTN is still cheap.
Yeah, far cheaper.
Very, very cheap. So what are the things that can really ruin the fortunes of a company like MTN? One would be if they have a huge debt. A high interest rate environment means that they are going to have to service that debt at a higher premium. But they don't have that. They're sitting on a good cash pile. So for the price at which it is trading, I know that MTN, if you look at it all from the weekly time frame, it is close because the weekly high was at 910 and it's currently trading at 805. So that's just like a 105 naira difference. But that for me, for what MTN offers, for a company that has over 51% of its market share. How many companies really sit on 51% of market share in the industry that they are operating in?
And they're second largest in the NGX.
It's the second largest in the NGX. But it's sitting on such, they're leaving 49% for all the rest of the participants, including Airtel Africa, to hustle. And by the way, just so you know, Airtel Africa, their biggest business is Nigeria. Yeah. So for me, that's like a canary in the coal mine, telling you that, listen, you guys are having a sleeping giant that you're not looking at. I know that people would say, on live last time, I talked about MTN, but I keep on saying most of these names because you cannot, and by the way, look at on all of these names, there's something else I considered. Are there other names that are very, very underpriced? Yes, but you also they don't scale the liquidity bar. Yeah. Because for me, there's no big deal in investing in a name in a company that no liquidity. That means if you're trying to exit, it will be a problem. You already know a name that I should be mentioning, but I don't want to mention that name.
You said about Hotel California.
There's a name that I will be mentioning, but I won't mention. There are some names that people have been trying to exit for some time now, for weeks now, because liquidity is off. So in terms of liquidity, in terms of valuation, I think the names that I mentioned on this show, those 6 names that I've mentioned, are names that they will benefit. They have decent liquidity and they are going to benefit in the current high interest rate.
And also in the long term.
And also in the long term. Because if you look at, I mentioned those insurance they have just scaled a hurdle, which was the recapitalization, and these names have been claimed by NICOM as successful. So now, what happened to the banks? The run-ups that we've had in banks, some banks have posted 60, 70, 80% year-to-date earnings. Or even if you look at 1 year, some of these banks have done over like triple-digit return in terms of their stock value to stock price. And that is because they are done with the recapitalization. So investors are confident in investing. I mean, before now, you can't really be able to, you can't really invest in an insurance name because you don't know which one will fall by the wayside. Okay, so, but now after post recapitalization, we can now be sure that those names that have scaled can really play the long game.
All right, thank you very much. I think you've done justice to it. And first, you've established why a stock you call a stock cheap. It's not a name for undervalued. It doesn't mean that the price is actually low. Thank you very much. Thank you very, very much.
You're welcome.
All right. On that note, we'll come to the end of today's episode of Clockwise. Please do not forget to like, subscribe, put on the notification bell on this channel because of the amazing content. Now, if you want to be part of our community, our Telegram community, there's a Telegram link on our profile that can lead you straight to our community where we have close conversation, real-time conversation every time on a daily basis. We provide answers to questions concerning investing in the stock market. Now, before you do any investment, please consult your stockbroker because this is strictly for educational purposes. It's not an investment advice. Neither is it a stock investment advice. My name is Providence. I'll see you again.